So every investing bro on the internet sounds like they've cracked the code to infinite wealth, right? Just buy the dip, bro. Time in the market beats timing the market. DCA is literally free money. Well, I decided to actually test these mantras with real data and real consequences. Spoiler alert, sometimes the advice works beautifully and sometimes you'd have been better off buying lottery tickets. Grab your coffee and let's dive into what actually happens when you follow the internet's favorite investment advice. Buy the dip, or how I learned to stop worrying and love the falling knife. Ah yes, buy the dip, the battle cry of every investor who thinks they're Warren Buffett after reading 3 blog posts. When prices drop, that's your opportunity. It's a sale. Be fearful when others are greedy, they say, conveniently forgetting that sometimes others are fearful because the building is literally on fire. Let's start with when this works. March 2020, COVID hits, market drops 34%, everyone's panic selling. You buy the S&P 500 at 2,200. Today, up over 150%. You're a genius. This is the story that spawns 1,000 buy the dip disciples. But let's rewind to 2000. March, tech stocks are down 10%. Time to buy. They fall another 15%. June, this is definitely the dip. Falls another 20%. By October 2002, the Nasdaq was down 78% from its peak. You'd finally break even in 2015. That's 15 years of waiting. Here's what nobody tells you. There's a dip and then there's a falling knife. You only know which one it was in hindsight. That 5% drop could be a healthy correction or the beginning of a 50% bear market. The phrase buy the dip contains zero information about which dip or whether the entire bowl of chips is about to fall on the floor. Real examples where this wrecked people. Japan 1989 took 35 years to recover. WorldCom, Enron, Lehman Brothers all had dips on the way to zero. Bitcoin 2022, 40K, then 30K, then 20K, then 16K. Which dip did you buy? Verdict, buy the dip works when you're buying diversified indexes during temporary panics. It fails spectacularly when you're catching falling knives or buying trash companies. Success rate, 7 out of 10. Time in the market beats timing the market, the one that's actually mostly right. This is the investing equivalent of eat your vegetables. Boring, responsible, and probably correct. The idea is staying invested beats trying to jump in and out at perfect moments, and the data actually backs this up. From 1980 to 2023, invest $10,000 and stay fully invested, you get roughly $1.1 million. Miss the 10 best days, $490,000. Miss the 30 best days, $165,000. Missing just 30 days out of 11,000 cuts your returns by 85%. Here's the twist. Most of the best days happen during the worst times. 7 of the 10 best days occurred during bear markets. So when your brain screams, sell everything, you're about to miss the recovery. But let's be honest about the emotional reality. It's March 2009, your $100,000 is now $55,000, every news channel predicts capitalism's end, your neighbor who got out early won't shut up. The math says stay invested, your brain says the world is ending. If you sold in 2009, you felt like a genius for 6 months. Then the market doubled, tripled, quintupled. You locked in a 45% loss right before the biggest bull run in history. When does this fail? You're retiring in 2008 and your portfolio drops 40%. Suddenly, time in the market matters less when you have no time left. Or you're investing your house down payment for 2 years. Stop. If you need money in less than 5 years, you're not investing, you're gambling. Or you're 100% in your employer's stock. Ask anyone at Enron how that worked out. Here's what makes this legit. Markets trend upward. Since 1928, the S&P 500 had positive returns 73% of the time yearly, 94% over 10 years, 100% over 20 years. But that's for broad market indexes, not individual stocks or whatever meme stock Reddit is pumping this week. Verdict, most solid advice of the 3 with caveats about timeline and diversification. Success rate, 9 out of 10 for diversified long-term investors. Just DCA, bro. Dollar cost averaging's dirty little secrets. Dollar cost averaging. Invest the same amount at regular intervals. When prices are high, buy fewer shares. When low, buy more. You average out volatility and avoid timing stress. It's the Costco rotisserie chicken of financial strategies. Reliable, affordable, nobody's mad about it. Say you started DCAing $500 monthly into the S&P 500 in January 2000, right before the tech crash. Terrible timing, right? Wrong. From 2000 to 2020, you put in $120,000 and ended with about $370,000. During 2008, while your coworkers' lump sum evaporated, you bought shares at a discount prices. This is DCA at its finest, the tortoise beating the hare. But here's the uncomfortable truth. Mathematically, lump sum investing beats DCA about 66% of the time. If you have $60,000, you're better off investing it all at once. Why? Markets go up more than down. Every month holding cash, you're missing gains. Vanguard found lump sum outperformed DCA 68% of the time in the US, so just DCA, bro, is mathematically inferior to just dump it all in, bro. But humans aren't calculators, we're emotional disasters. Yes, lump sum wins more often, but when it loses, it's spectacular. Invest $100,000 in January 2022, watch it drop to $75,000, then explain to your spouse why you gambled everything at once. With DCA, you'd only have $83,000 invested with $17,000 on the sidelines, smaller loss, and you'd have buying opportunities ahead instead of just pain. When does DCA fail? You start in 2010 during a decade-long bull market. Every month you're buying higher while your friend who lump summed in January 2010 enjoyed gains the whole time. Or you're DCAing Beanie Baby Coin weekly. Cool, you're systematically buying garbage on a schedule. DCA doesn't fix bad investments, it just spreads them out. It's like eating poison slowly. You still end up dead, just with better pacing. Where DCA shines? Automation. Your 401k? That's DCA. Money goes in automatically every paycheck. You can't panic sell if it auto-invests before you see it. You can't time the market if a payroll system does it. Verdict: mathematically suboptimal, but psychologically optimal. It's training wheels. You might go faster without them, but you're less likely to crash. Success rate: 6 out of 10 for math, 8 out of 10 for didn't panic sell and actually stayed invested. So what should you actually do? Here's what I learned. Every piece of popular investment wisdom works sometimes and fails sometimes. If there were a guaranteed strategy, everyone would do it, then it would stop working. Buy the dip works for temporary dips in quality assets, fails on falling knives. Time in the market is statistically solid long-term, but fails for short timelines. Just DCA is psychologically brilliant, but mathematically mediocre. And that's okay, because it keeps you invested, which is 90% of the battle. What actually matters? Diversify. Don't put everything in one stock or invest it all at once unless you can handle volatility. Match strategy to timeline. Need money in 3 years? Don't use stocks. Got 30 years? Ignore the noise. Automate everything. Max out your 401k, set automatic investments, live your life. The best strategy is one you'll follow. Understand what you own. If you can't explain why in one sentence, don't own it. Because it's going up isn't a sentence, it's a gambling addiction. Prepare for the psychological battle. This sounds great until your portfolio drops 30% and your cousin won't shut up about selling at the top. That's when boring wins. I tested all this advice and found the commonality among successful investors isn't which strategy they used. It's that they started early, stayed consistent, didn't do anything catastrophically stupid, kept fees low, and waited decades. That's it. Not exciting, won't make you rich overnight, but works more reliably than trying to be clever. So did I test popular investment advice so you don't have to? Yes. Find a perfect strategy? No. Confirm advice is context dependent and works better as guidelines than rules? Absolutely. Should you max out your index funds and stop checking your portfolio 17 times a day? Yes, you should. Now, if you'll excuse me, I need to explain to my accountant why I bought cryptocurrency during the worst possible week in 2022 for science. Stay invested, stay diversified, and stay sane out there.